Index ETF. An index ETF is designed to track a market index, such as the S&P 500, the Nasdaq 100, or the FTSE 100. Instead of trying to beat the market, it simply follows it by holding many of the same companies in similar proportions. These funds became popular because they offer broad diversification, low costs, and a simple way to invest in an entire market through a single purchase. Stock ETF. A stock ETF holds shares of publicly traded companies. Some focus on large corporations, while others target smaller businesses or specific regions of the world. Investors use them to gain exposure to equities without having to choose individual stocks. Their performance usually depends on how the underlying companies perform over time. Bond ETF. A bond ETF invests in government, municipal, or corporate bonds. Traditionally, bonds were often purchased individually, but ETFs made them easier to access. They are generally used by investors seeking income, lower volatility, or a balance against stock market risk. Their value is influenced by interest rates and the credit quality of the bonds they hold. Sector ETF. A sector ETF focuses on a specific part of the economy, such as technology, healthcare, energy, or finance. Rather than owning the entire market, investors can target industries they believe will perform well. These funds allow people to express specific market views while still maintaining diversification within a single sector. Industry ETF. An industry ETF narrows the focus even further than a sector ETF. Instead of covering a broad area like healthcare, it may concentrate on biotechnology, medical devices, or pharmaceutical companies. Because of this specialization, industry ETFs can experience larger gains and losses than broader funds. International ETF. An international ETF invests in companies located outside an investor's home country. These funds provide access to foreign markets that may grow differently from domestic ones. By spreading investments across multiple countries, investors can reduce dependence on the economic performance of a single nation. Emerging Markets ETF. An emerging markets ETF targets developing economies such as India, Brazil, or Indonesia. These countries often have faster growth potential than developed markets, but they can also face greater political, economic, and currency risks. As a result, these ETFs tend to be more volatile. Dividend ETF. A dividend ETF focuses on companies that regularly distribute a portion of their profits to shareholders. Some funds prioritize high yields, while others seek businesses with long histories of increasing dividends. Investors often use these ETFs to generate income alongside potential capital appreciation. Growth ETF. A growth ETF holds companies expected to increase revenue and earnings faster than the overall market. These firms often reinvest profits instead of paying dividends. Technology companies frequently appear in growth-focused funds, and their returns are closely tied to expectations about future expansion. Value ETF. A value ETF invests in companies that appear inexpensive relative to their earnings, assets, or cash flow. The idea comes from the belief that markets sometimes undervalue solid businesses. Investors who favor value strategies look for opportunities where stock prices may eventually move closer to a company's true worth. Small Cap ETF. A small cap ETF concentrates on smaller publicly traded companies. These businesses often have more room to grow than established giants, but they may also face greater uncertainty. Because of that balance between opportunity and risk, small cap ETFs can experience significant price swings. Mid-cap ETF. A mid-cap ETF invests in companies that sit between small and large corporations in size. These firms are often established enough to have stable operations while still maintaining meaningful growth potential. Many investors view mid-cap stocks as a middle ground between stability and expansion. Large cap ETF. A large cap ETF focuses on some of the biggest companies in the market. These businesses usually have strong brands, global operations, and long operating histories. While they may grow more slowly than smaller firms, they often provide greater stability during uncertain periods. Commodity ETF. A commodity ETF provides exposure to physical goods such as gold, silver, oil, or agricultural products. Some funds hold the commodities directly, while others use futures contracts. Investors often use commodity ETFs to hedge against inflation or diversify beyond traditional stocks and bonds. Gold ETF. A gold ETF specifically tracks the value of gold. Before these funds existed, investing in gold often required purchasing and storing physical metal. Gold ETFs simplified the process by allowing investors to gain exposure through ordinary stock exchanges. Real estate ETF. A real estate ETF typically holds shares of real estate investment trusts, commonly known as REITs. These companies own income-producing properties such as apartments, offices, warehouses, and shopping centers. The fund gives investors access to real estate markets without buying physical property themselves. Currency ETF. A currency ETF tracks the value of one or more foreign currencies. These funds are used by investors seeking exposure to exchange rate movements or looking to hedge against currency risk. Their performance depends largely on changes in global monetary and economic conditions. Thematic ETF. A thematic ETF is built around a long-term trend or idea rather than a traditional industry classification. Examples include artificial intelligence, cybersecurity, robotics, clean energy, or space technology. These funds allow investors to focus on themes they believe will shape the future economy. ESG ETF. An ESG ETF selects investments using environmental, social, and governance criteria. The approach gained popularity as more investors wanted their portfolios to reflect certain values or sustainability goals. Different funds apply these standards differently, which can lead to significant variations in holdings. Smart Beta ETF. A smart beta ETF follows a rules-based strategy that goes beyond simple market cap weighting. It may emphasize factors such as value, momentum, quality, low volatility, or dividends. The goal is to capture specific characteristics that some investors believe can improve long-term returns. Actively managed ETF. An actively managed ETF relies on professional managers who make investment decisions instead of simply tracking an index. The managers can adjust holdings as market conditions change. This approach offers flexibility, although it usually comes with higher costs than passive index ETFs. Leveraged ETF. A leveraged ETF aims to produce a multiple of the daily return of an index or asset. For example, a fund may seek to deliver twice or 3 times the daily movement of a benchmark. Because they reset daily, these ETFs are generally designed for short-term trading rather than long-term investing. Inverse ETF. An inverse ETF is designed to move in the opposite direction of its target index. If the benchmark falls, the ETF is intended to rise. Investors often use these funds for hedging or short-term speculation, although their structure makes them more complex than traditional ETFs. Crypto ETF. A crypto ETF provides exposure to digital assets such as Bitcoin or other cryptocurrencies. Some funds hold the assets directly, while others track related futures contracts or companies connected to the crypto industry. They allow investors to participate in the cryptocurrency market through traditional brokerage accounts. Please subscribe and like to motivate me to make more of these videos.